What were the roles of IMF and World Bank after Bretton Woods? Imagine a world trying to rebuild after a devastating war, with economies shattered and currencies unstable. That's the world the Bretton Woods Conference aimed to shape. After the meeting in 1944, two key institutions were created to help guide this new global economic order. Their roles were different but worked hand in hand to promote stability and growth. The International Monetary Fund, or IMF, was mainly responsible for keeping the international monetary system running smoothly. Its main job was to oversee fixed exchange rates among countries, making sure currencies didn't fluctuate wildly. It also provided short-term financial help to countries facing balance of payments problems, which means they didn't have enough foreign currency to pay for imports or service debt. This support helped countries avoid financial crises and kept international trade flowing. The IMF also promoted cooperation among nations on monetary issues, encouraging them to work together rather than compete with each other. This was vital for rebuilding economies and preventing the kind of instability that had led to the Great Depression and the economic chaos of the 1930s. Meanwhile, the World Bank focused on rebuilding and development. Its initial goal was to help countries recover from the destruction caused by World War II. It provided long-term loans and financial aid to rebuild infrastructure like roads, bridges, and power plants. This helped countries restore basic services and jumpstart their economies. Over time, the World Bank expanded its mission to include helping poorer and newly independent nations develop their economies. It financed projects in health, education, agriculture, and industry, aiming to reduce poverty and improve living standards. The World Bank also supported social programs and environmental projects, recognizing that sustainable growth depended on more than just infrastructure. Both institutions worked together to create a stable environment for economic growth. The IMF's financial support helped countries keep their currencies stable and avoid crises. The World Bank's development loans built the foundation for long-term growth and poverty reduction. As the world changed, so did their roles. The IMF shifted focus from fixed exchange rates to managing financial crises and advising countries on economic reforms. The World Bank moved from Reconstruction to broader development goals, including fighting poverty and addressing climate change. In essence, after Bretton Woods, the IMF acted as a guardian of monetary stability and short-term crisis management, while the World Bank served as a builder of long-term economic strength. Their work helped shape the post-war world and continues to adapt to new global challenges today.